All right, we're excited about today's webinar. We're going to give just a few more seconds for everybody to load on. We've got a lot of folks signed up for today's market update webinar, and we'll give everybody just a few more minutes. Hope everyone's having a good start to your week. I know later this week, many of you might be doing some type of Halloween trick-or-treating, especially if you've got kids or grandkids, something to look forward to. And this is our last webinar for the year, and it's really centered around Q4, year-to-date market performance. We're going to take a look at some economic outlook for 2026 and some other things. But before we do that, let me just do proper introductions. My name is Greg Patterson, and I am joined with my colleagues again, J.A. Kennedy, Jen Mann, and Tara Gould. And we are excited to be part of Atlantic Wealth Management here in Morehead City. And we look forward to providing these quarterly market updates and webinars so that you can take action on the things that are most important to you. And we want to make sure that you have the latest information. So with that, and I think everybody's loaded in here, we're going to go over our agenda for today. We're going to talk through market performance and the returns of the market year to date from January to today. We're also going to talk through the 2025 economic data. Some of that is not out for the most recent month due to the government shutdown, which we will also talk about and how that impacts markets, both currently and what we think to come. Also, we're going to go through some year-end financial planning, some important things you should be taking action on, and we call that action items. And then lastly, we want to go over conclusions to share our thoughts and important takeaways from today. So with that, I hope everybody's got their pen and paper ready to take notes, and we will go ahead and kick us off. Jen, you want to get us started?
Absolutely. All right, so first we'll talk about asset class returns. We always like to look at this chart because it's just so pretty and colorful. But this is one that we always like to revisit, again, known as an annual asset class return chart. What this chart does is it outlines the performance of 9 different asset classes over the period of 2010 to 2024. And we've even got 2025 through the end of Q3 in here as well, along with a diversified portfolio that's rebalanced annually, which is the white box you'll see kind of staying in the center of the screen. We'll call that one asset allocation, as you can see. So we like to refer to this piece to illustrate the point that on any given year, it's particularly difficult to determine which asset class will outperform all others. We'd like to try, of course, but the asset class that will come out on top in any given year can vary. And it's easy to see why we can't rely on performance in a previous year to predict which one will be this year's winner. So in any particular asset class, we can see some pretty sizable swings. So as an example, if you look at REITs in 2020, you'll see it comes in at the bottom of its column. But if you look in 2021, it bumps to the top. So that's a pretty sizable swing. Looking at 2025 through September 30th, we can see that emerging markets equity, developed markets equity, and large cap, or what we know as the S&P 500. Those are coming out on top so far. So we'll look forward to seeing what the final quarter brings to see how the chart ends up at the end of the year. But our main point in showing this is that over the long term, we can see that when one is invested in a diversified portfolio that is rebalanced periodically, like we do here, and again on this chart that's illustrated by our white asset allocation box, that kind of strategic positioning tends to smooth out those big swings and take some of the guesswork out of the portfolio management process. So it's time-tested investment principles such as these, and they just show the importance of diversification and regular rebalancing. And that truly does help drive our investment management process here at Atlantic Wealth.
Thank you,
Thanks,
Jen.
Jen. interesting emerging markets. You can see for the last few years, it's been towards the bottom, or maybe in the middle of the pack last year, but the previous 2 years. So speaks to exactly what you're talking about there. This is piggybacking off of what Jen was communicating a bit, but she was talking about different sectors. We're looking here at different size companies. Eric, when we look at the stock market or the equity market, we can look at what is called large cap companies. So these are the larger companies that comprise the market. Mid cap, which would be medium size, exactly how it sounds in the description, and then small cap, which would be those smaller companies. You can see here on just a 10-year annualized return chart here that it makes sense that growth focused returns would be higher than value. And I guess let me also speak to growth and value. So we've got small, mid, and large, and then we've got growth and value. When we talk about growth, we're talking about a lot of times we jump to more technology companies that are not historically haven't paid a lot of dividends, although today a lot of growth companies that will pay a small dividend in the market today. But the contrast to those growth focused companies would be what we might term blue chip companies, or companies that have been around a long period of time, consistently paid dividends, in some cases increasing dividends over time. So their earnings, instead of pouring them back into research and development, innovation, they take a large portion of those earnings and send them out as dividends. And we would call that kind of the value bucket of the market. But you can see how things shake out return wise across those different areas. And this chart at the top left is just a 10-year annualized chart showing growth at 18.8% all the way down to small cap value at 9.2%. If we look year to date, we can see these returns year to date have been not out of bounds from what the 10-year annualized returns have been across these style boxes. These charts at the bottom, the bottom left, we look at since January of 2022. If you'll recall, January in 2022 was a down year in the market. So we retracted a bit, and then we've had a pretty good run since then. And then since the market low in October of 2022, you can see these returns, cumulative returns of in excess of 100% in the growth bucket. So there's been a lot of talk over the last 2 or 3 years about those Mag 7 companies, the ones that have driven a large part of the market, and that shows up in that growth area of the style boxes. Just one other thing I wanted to touch on the right here, which is valuations. You may, if you've been keeping up with the market or seen news headlines, there is talk about how valuations are high right now in the equity market, and there is some truth to that. And I'll speak to what that means going forward and the things to consider. But basically, when we talk about valuation, we're saying we're looking forward at the next 12 months at what the projected earnings are going to be for a company, and then comparing earnings per share, and we're dividing that into the price to come to an earnings multiple, a price to earnings multiple. And so you can see the forward price to earnings multiple versus 20-year averages that show here where, for example, in the growth bucket, currently we're at 31 times earnings. 20-year average has been right at 20, so higher than average. And in each of these areas, we are higher than historical averages. And then you can see here as a percentage of, it's just basically translating the top chart into the bottom one to show it as a percentage of historical average. So those numbers are higher than we've seen historically. It doesn't mean that the market has to go down from here. In fact, we would say if we just take a snapshot of the market right now and the economic environment, there's probably more tailwinds pushing things along in a positive direction than there are headwinds, albeit there are headwinds out there as well. But we've got, a rate environment that the Fed has started to cut rates. So as we look at projections for that to continue for a bit, that is positive. We've had earnings expectations that have been revised upwards more than downwards by these publicly traded companies. And we've got a stable operating environment from a policy standpoint. You can say what you want to about the one big beautiful bill, but it does mean that companies can plan around the future, at least for the next few years, in a way that they don't have to be wondering what our tax rate is going to be next year or the following year. So that bodes well for certainty over uncertainty in the market. So that's what I want to touch on with regards to just valuations and style.
I'm going to just continue the conversation here, just discussing returns, but I want to look at different sectors, and I'm going to add on a little bit to some of the things that JA spoke on valuations. So when we're looking at sectors, technology, communication, clear leaders, both of them are up over 20% year to date, driven by companies. We're going to recognize these names: Apple, Microsoft, NVIDIA, Alphabet, which is Google, and Meta, which is Facebook. Strong earnings growth and enthusiasm around, you guessed it, AI, cloud computing have really helped lift these sectors. Together, they now make up more than half of the S&P 500. So what does this mean? It means a small group of very large companies have an outsized influence on overall returns. So we talk about concentration. Concentration can work both ways. It can boost performance when these names do really well and they rally, but also can create some sharper pullbacks if leadership rotates. From a more traditional sector, income-oriented, we talk about energy, financials, maybe consumer staples. Think of companies like Exxon, JP Morgan, Procter & Gamble. They have lagged somewhat. They're more tied to interest rate and commodity cycles, but now they're trading at lower valuations. So for example, JA was talking about PE ratios earlier. Energy and financials are sitting 16 to 17 times forward earnings. And we compare that to technology, and that's closer to 30 times. So what this means is investors are willing to pay more for that expected growth. So that price to earnings multiple, the breakdown of that is how many dollars are investors willing to pay for $1 of company earnings. So we were talking about energy and financial, that's 16 to 17, and technology is upwards of 30. Next, I want to highlight the beta row. So beta, if you've been around investing, you've heard the term beta before. That simply just means a measure of volatility relative to the overall market. So if we say it has a beta of 1, that particular stock is going to move roughly in tandem with the S&P 500. If it has a beta higher than 1, it's going to be more volatile, so higher highs, lower lows. If it's below 1, it's going to be a little bit steadier. So what we know is technology and communication services, they're around 1.2%, so a bit more volatile. And then we come in with utilities at closer to half or 0.5. I'm sorry, I misspoke. It's 1.2. It's not a percentage. And then utilities at 0.5, meaning that it swings less, and this can add stability to a portfolio. And then the last thing I want to look at on this chart is dividend yields. We like talking about dividends. So the overall S&P 500 averages around 1.5%, but those sectors you can see, utilities, energy, consumer staples, they often pay higher. Maybe the average coming in around 2.5 to 3.5. And that steady cash flow, it can be meaningful, especially if I'm talking to retirees, to supplement income without having to sell shares. So key takeaway here is we know the market is dominated by growth sectors, but making sure we maintain diversification with that value and income areas.
Yeah, I think that is a the big takeaway here is that it's important to be diversified. It's important to rebalance and make sure we don't get too far out of bounds from a risk standpoint as those growth areas
With the
perform
growth.
well.
Absolutely.
And that's what we've done this year in our money management with our clients. So now for just economic outlook, a brief snapshot of how things stand in the economy. If you've been on previous webinars, we just take a couple minutes to go through a rundown of each of these items. And we'll start with consumer spending at the top there on the visual. If we look at consumers and retail sales is one of the ways in which we measure consumer spending. The last number we saw was a 5% growth year over year in retail sales. So if we look at inflation rate around 3%, retail sales around 5%. So consumers are continuing to spend at a rate over and above inflation. Employment is the next box there. And Greg mentioned on the front end just about data, economic data, some of it being delayed, or we may have to wait longer for more current data with the government shutdown. That is the result in this employment area. The last information we have goes back to August, which was reported at the beginning of September. But basically, unemployment rate is right around 4.3%. It ticked up just 1/10 of a percentage point. It's not an alarming level at this point, but it did tick up a bit. And the other trend I would say from an employment standpoint is we have seen job growth trend downward slightly. So still positive growth, but we've seen less new jobs created of late. We'll continue to watch and monitor that. I think that's also given the Fed some ammunition to start their rate cuts, where we've seen the 1/4 point cut thus far. Personal income, this is up as well in the past year over year is up 5.1%. Kind of dovetails with the spending. So that would tell you personal incomes on the whole up 5%, spending's up 5%. Consumers are spending their income increase, right, in the economy, which continues to push the economy forward in a positive direction. Then manufacturing. This has been kind of an up and down category as we look at manufacturing and industrial production. Industrial production has beaten expectations, just the latest results that we've had come out for last month. But manufacturing is still, it's a diffusion index that we measure manufacturing within the economy on, and if it's lower than 50, we say that it's negative. If it's higher than 50, then we're at an expansion point, and it's right under 50 right now currently. So again, that's another area we'll continue to monitor going forward. Hopefully we will move forward in a positive direction into expansion from a manufacturing standpoint. And then housing, the rate decrease that we have seen, the 25 basis point cut, we have seen some activity pick up on the housing front. New home sales continue to be the biggest year over year driver, but the existing home sale market has opened up a bit, and that's been positive. If we look over last year, this time to this year, existing home sales are up about 2%. So I would expect that to continue to trend in a positive direction as we continue to see rate cuts that are expected. And then GDP, we had this may be one of those data points that will be delayed. The September 30th was the end of the third quarter, and we expect supposed to get a result out on that this week. We'll see if that comes out or if we have to wait a bit. But the latest data the latest revision we had for the second quarter was very positive. We were expecting a 3.3% for the second quarter, and the third revision had it at 3.8%. So that's a very healthy rate of growth. The first quarter was negative, but that's a very healthy rate of growth in the second quarter. Really, we've talked before about averaging those two to come to kind of a reality of the situation. I think in general, things have been a little bit slower this year than last year, but we're continuing to grow to this point. And then inflation is in the middle. Interestingly enough, they did bring some government employees back into the office so that they could get the latest number for inflation. And that update looks like 3% for year over year on the CPI, Consumer Price Index. They needed to do that so that they could update the Social Security cost of living adjustment for this coming up year. So that was important, and it is important. So, but the other data we may have to wait on for a while. We're not too far behind. We're just, a month in, not quite a month in. So a lot of the data is still current. But if we continue to move forward, we'll have to work with what we get. So that's the economic update.
Thanks, J.A. Speaking of government shutdowns and the markets, I was the one to draw the short straw and have to share the info on the government shutdown with you. So let's talk about the shutdown. This is a federal government shutdown. If you've driven down Arundel Street or Highway 70, our state government is still alive and well, and they're working on paving roads. That's the DOT. That's the state government. We're talking about a federal government shutdown. And in the last 30 years, the government has been shut down 80 days. I have some good news. In any of those time periods, there was not a recession going on. So it has not been recessionary in the past. That's rearview mirror stuff when we're looking at it. And if you take a look to the top right hand of the page, you can see in blue the past government shutdowns, the longest one being 2018 and 2019. If you remember, if you're watching your news shows during that time period, you had Nancy Pelosi, Chuck Schumer, President Trump, and his vice president, Mike Pence, in the Oval Office talking about the government shutdown. It made for some good political theater, but ultimately the government reopened. I think the current estimate is about 750,000 jobs are impacted at this point and what we call furloughed. J.A. and I went up to our nation's capital for a conference this past weekend, or the weekend before, Monday, Tuesday, and Wednesday. We wanted to go to the Marine Corps Museum, that was shut down, and we also wanted to go to the Smithsonian, and that was shut down. But anybody that's affiliated with DoD or termed essential services are still at work, and they're still working. So this all revolves around compromise and the ability of Congress to work together to address some of the critical issues with our country's spending. Right now, I think the current number is the deficit is clocking in at $1.775 trillion for fiscal year 2025. And this just ended on September 30th. The shutdown started the next day on the 1st, and we're 27 days into it with no end in sight. But mind you, the compromise can happen, and I think it will happen, and you'll be able to see the government get back to work. Right now, the estimate is $41 billion in spending, $41 billion less than the deficit the prior year, and $34 billion smaller than what the Congressional Budget Office projected the deficit would be only 2 weeks ago. So there is progress being made, but it is going to take some spending cuts, we think. And when this happens, I believe when there's compromise around that, we'll be able to see the government reopen. There's also been 20 funding gaps if you look back to 1977. And so while that wasn't a full shutdown, there was time in our nation's history where there have been funding gaps. And we've also had a surplus in our country's history in our lifetimes too. So it is possible to fix the situation. And just a bit of perspective that doesn't have to do with the shutdown, but is interesting history to note. In 1962, this day, October 27th, 1962, the United States and the Soviet Union stepped back from the brink of nuclear war. So there were, if you remember, if you're old enough to remember this, there were complicated and tension-filled negotiations between the US and the Soviet Union, which finally ended after the Cuban Missile Crisis. This no doubt was a frightening period in our country's history, and a lot of anxiety around that, and probably in my estimation, a time that we haven't seen since. But nonetheless, this is why we advise our clients to look at the long term, focus on their goals, and these types of situations do resolve themselves. At the bottom of the page, you'll see returns on a 1 month, 3 month, and 6 month period after each time period. Again, we're not in a recession now. We don't think this is recessionary. It could be a drag on the economy if it does go longer term, but it also might help some of our spending issues as a country. So that's what I wanted to say about the government shutdown and the issues around that.
All right, I'll take it from here. Transitioning topics a little bit, I want to review just a few items as we close out the year. These are specific financial planning moves, maybe reduce taxes, really just strengthen your overall plan. So first is max out retirement accounts. When I'm speaking about retirement accounts, I want to highlight employer plans, 401ks, things of that nature. So for 2025, you can contribute $23,500. And then if you're over 50, there's an additional catch up, so 7,500 catch up. Also, this is a newer addition. Secure 2.0 added a special, it's called Super Catch Up. And this is specifically for ages 60 through 63, allowing for an additional 11,250. So the initial catch up is if you're over 50, the super catch up is between those ages of 60 and 63. And this is specifically on employer sponsored retirement plans. For your IRAs, your individual retirement accounts, the limit for this year, the contribution limit, and I'm just speaking overall, there's some other considerations as far as income and deductibility, but the contribution limit is 7,000. Plus, if you're 50 or older, you can contribute an additional 1,000. A few key dates to remember. So your 401k, your employer sponsored contributions must be made by December 31st. We want to talk about this now because if you are eligible to contribute more to your retirement plan and you're in a position to do so, sometimes that takes a pay cycle or so to kick in. So go ahead and take a look at that for the employer plans. The IRAs, we would encourage you to contribute to those when you have the funds available, but just noting that you have until April 15th or the tax deadline of the following year to make a contribution for the prior year. Next, just a little bit on losses and gains. We call this tax loss harvesting. And this is just something I want to bring to your attention. We not only look at this at the end of the year in accounts, but also throughout the year. And this is on a step in our process on the accounts that we manage. So when we're talking about tax loss harvesting specifically, what this means, it's kind of a cool term that people will often say, do you do this? Yes. Tax loss harvesting means we're just selling investments that have declined in value to offset gains somewhere else. So for example, if you sold a stock or a fund early in the year at a gain, and later on in the year, we're able to realize a loss that can offset that gain dollar for dollar, reducing your overall capital gains tax. It can also work the opposite way. And so something to think about or consider, if you're in a lower income year, you could potentially be in a very low capital gains bracket, maybe even 0%. You could intentionally sell an appreciated investment because you know you're going to need the proceeds from that investment at a later time, and go ahead and realize that gain at a low, maybe even a 0 rate, to reduce your cost basis or to reset your cost basis for the future. Both of these strategies specifically have to be completed by December 31st, but they can make a noticeable difference long term. Number 3, love talking about required minimum distributions, and this is on your IRAs and also those inherited IRAs, or we call them beneficiary IRAs. On the accounts that we manage, we are tracking on this. We will be contacting you if you haven't requested your required minimum distribution. But if you have a self-directed IRA or even an employer plan, you do have to take an aggregated amount that meets the overall requirement. So now RMDs, the age is 73, and there is a penalty if you miss your required minimum distribution. Keep in mind that if this is your first RMD, so this is the year 2025 in which you turn 73, you have the opportunity to delay your first RMD until April 1st of next year, so 2026. However, this means that you will then have to take 2025 RMD and 2026 RMD in the same year, and that could potentially bump you into a higher tax bracket. We do help clients coordinate your RMDs. We want this to be in line with your cash flow needs and also thinking through tax efficiency. So RMD proceeds could fund living expenses, but also you can make charitable gifts, and I'll talk about that in just a second. And also note that you do have to take the funds out of the IRA or beneficiary IRA, but you can reinvest them into your taxable investment account. Next is charitable gifts or qualified charitable distributions. Just charitable giving. We love talking about charitable giving and being generous, but I also just want to highlight a way in order to give effectively and efficiently. If you itemize, those traditional charitable contributions are deductible, and timing those before year end is going to help offset this year's income. But if you don't itemize and you are qualified to do a QCD or qualified charitable distribution, so what a QCD is going to allow you to do is to give directly from your IRA to that qualified charity, and that's the key, is it has to come directly from your IRA to go to that charity. If you take the funds out, put it in your checking account, and then contribute, that doesn't qualify as a QCD. But note that the age is a little bit different. So for RMDs that require minimum distribution, 73, but if you're 70 and a half, you can make a qualified charitable distribution. The number for this year is up to 100,000. This is per person per year. It does satisfy your RMD, and it is excluded from your taxable income. So why is this important? Yes, it does exclude from your taxable income, but think about this. It reduces your overall adjusted gross income, which is going to help avoid that potentially higher Medicare premiums known as IRMAA. And it could also limit the taxation on your Social Security benefits. If you're someone who gives annually, we often like to talk about bunching deduction. So what that could mean is 2 years worth of giving in one tax year to maximize those itemized deductions, or consider this. It's called a donor advised fund. You could actually make a charitable gift, a large deductible gift this year, and then you would distribute those grants to charities over time. If you have questions about any of these items, we are happy to discuss them with you and help coordinate the details.
Thanks, Tara.
course.
Wanted to just highlight, we have been blessed really to be able to facilitate client giving. And a lot of that is done between now and the end of the year. We do a lot of qualified charitable distributions. Some of you probably are doing them already, but it is something definitely to consider, as Tara already mentioned, for all of those benefits. And as well as the donor advised fund gifts, we've also helped facilitate that. I did want to give just a quick update on where we stand from a client giving standpoint. We do track the giving we're able to facilitate. And if we look at just calendar year last year, 2024, it was over 900,000 in client gifts that went out to almost 200. I think it was right just under 190 different charitable organizations. So that's ranging from churches to civic organizations to law enforcement to education, research, environment. The list could go on, but that's a big number of organizations that we've helped clients give money to, and we'd love for that list to increase and for the dollar figure to increase. So we always like to challenge folks, especially this time of year, to consider that as we look towards the end of the year.
Awesome. All right. Very good. So just a few more year-end planning topics to consider, adding on to Tara's list that she started a few minutes ago. So income deferral. So in the event there is a need to delay a bonus or perhaps an investment withdrawal to 2026, with the goal of reducing your taxable income, or ensuring that you don't advance into the next tax bracket, that is something to consider. Again, we can help you take a look at that and figure out if that makes sense for your particular situation. You may also want to consider a Roth IRA conversion. Basically, this allows you to convert pre-tax funds into a Roth IRA, or perhaps for higher earners, you could consider utilizing a backdoor Roth IRA strategy. The goal being to hedge against potentially higher future tax rates and pay at a lower rate now. Avoid having to take RMDs since you don't have to take those from Roth IRAs. And of course, enjoy tax-free retirement income from the Roth when the time comes. So the deadline to perform a Roth conversion is December 31st. So if that's something you're considering, we are up against that year-end deadline for doing so. Another thing we like to point out, flexible spending accounts, FSAs. If you have funds in an FSA, you must use them or lose them by December 31st. And of course, FSA funds can be used toward eligible health and dependent care expenses. So that's something to put on the to-do list to look at if that applies to your situation. And of course, reflect on your financial goals for the year. Year end is a great time for overall reflection and looking back on any goals that you may have set for 2025, assess your progress on those, and of course, set priorities for 2026. It may mean adjusting certain goals, maybe bumping them into 2026, maybe increasing contributions going forward, fine-tuning savings targets, or maybe making tweaks to your budget. And of course, number 9, we are here to help you by discussing any of these, those that Tara mentioned or those that I've covered. We can help you evaluate, as she said, RMD, QCD, Roth conversion opportunities, charitable gifting strategies. That one's near and dear to our heart, along with anything else. If there's something you need to discuss, as always, please don't hesitate to reach out, schedule some time with us, and we can help you finalize those year-end strategies and get it done in time.
Thanks, Jen.
Yeah.
So with the time drawing near to our close on this webinar, I thought it would be helpful to go over some key takeaways today. Let's not overlook the opportunities that exist out there. Even in spite of some headwinds with this government shutdown or other concerns, there is still opportunity. And as your financial advisors, if you're a client and you're on this call, please know that we've done this for you in terms of rebalance and actively managing your portfolio. We've sent you emails along the way to share with you what we're doing and why. And so this type of active management is something that we're doing on your behalf. If you're not a client and you're on this call, I think there's a lot of opportunity out there today in AI, for example. There was some stats that I read on this too, that the surging capital investment, so this would be corporate investment into AI, reached a record 252 billion last year. And that's mostly US companies leading the charge. And this year, big tech firms like Amazon, Google, Meta, Microsoft have already spent increases this year up to 364 billion. So this is just investment into artificial intelligence. We're seeing widespread business use of this. In fact, it grew 78% last year and is continuing to grow. And those companies that produce or are involved in that space, even the picks and shovels, like semiconductors and chips, are very much a part of this opportunity. So that's large cap growth. You heard Jay talk about that. You also heard Jen and Tara provide insight and the results of that this year. And I think that's a good opportunity if you are a growth investor. But I also want to stress the second takeaway here: review your cash position. With stocks up year to date, it may make sense for you to take a look at your current cash position. If you don't have enough in savings, now's a good time that you might want to reposition some of the growth assets to cash to help you with goals that you have coming up on the short term. However, if you look at your cash position and you realize you've got more than 3 to 6 months worth of savings set aside, it might be a good opportunity to invest that cash into those companies that are making money. It's also important to realize, with the Fed cutting rates in September and likely to cut rates again before the end of the year, the meetings this week, we'll see that your cash position is declining. The interest that you're earning on that is declining. So perhaps that might make sense to look at the opportunities out there. The third thing is emotional.
Hey, one quick update on that, Greg. The total money market, total balance in the U.S. in money market accounts is at a record. It's over almost $7.4 trillion. And so that we would say that's likely to be, some of that money is probably likely to come back into the market as rates come down. So don't be on the back end of that, the tail end of that, if you do have too much cash, as Greg was talking about. That would also be another tailwind that we would say would potentially push things forward in a positive direction.
Exactly. And that is one of the things that we speak with you about at your review meetings, where we proactively invite you into the office to review over your situation. This third item, emotional versus strategic changes. Again, if you're watching a lot of news and your news media coverage is high, it might lead you to anxiety or emotional, what we would consider a knee-jerk reaction. Again, one of the roles we play in your life is to help talk you through that. And I think over a long period of time, if you stay invested towards your goals, you're more likely to realize those versus making emotional changes. And the strategic changes are just what I alluded to earlier. If you're a client, we are helping you by making these strategic changes on your behalf. Most of our clients are really thankful that we do this for them. In fact, the conversation generally sounds something like, "We're so glad that you guys are looking over our situation and making those adjustments for us." So that is a proactive way that we help you by looking out the front windshield of your investment car and making those updates. And then lastly, we've talked about this in different segments of today's webinar, we want to maintain a long-term outlook. From day to day, it could look murky. In fact, the markets could even become choppy. And what we tell you over time, you're likely to experience recessions and generally have 2 negative years of results out of every 10 years or every decade. That's just part of the process. It's not something that you don't make money every single year for 10 years. So the long-term outlook, however, make sure that your cash position is right and what you have set aside for shorter term or even intermediate term goals, you're able to meet. And then the longer term outlook keeps you ahead of, or the longer term money keeps you ahead of taxes and inflation, which I believe we've seen that inflation and taxes are the real culprits to any type of money. So you do need to take some risk to overcome those issues.
Thanks, Greg. We always like to wrap up our webinars with biblical wisdom and truth. And so we do that with a couple verses from Colossians chapter 3 today. Whatever you do, work heartily as for the Lord and not for men, knowing that from the Lord you will receive the inheritance as your reward. You are serving the Lord Christ. And this is really how we across the team approach our work every day. God has blessed us with the ability to serve great folks like many of you, great clients, and we're able to help, with your planning and investments and financial lives, but also beyond in many cases. But ultimately, we are serving the Lord who has extended the ultimate reward in salvation through Jesus Christ. And so it's in that light that we come to work every day and we serve and we strive for excellence. And we appreciate the opportunity to do that for you guys.
All right, so here we are at the end of the webinar. Thank you for joining us. I know we covered a lot. If you do have questions or want to talk through your situation in detail, as we shared, feel free to give us a call or shoot us an email. We're happy to sit down with you and go over the specifics of your situation. Also, make every day count. Do those things that you want to enjoy doing and that you're, that are on your mind. If it involves finances and you have a goal, let us know about it and we'll help you accomplish that. Our next webinar will be in the new year. Until then, we hope to see you at an event, or I hope you've got your calendars marked up for the great pie giveaway coming up in Thanksgiving, the week of Thanksgiving. Otherwise, we will be seeing you soon. Take care.